Do you want to know how to buy a house with a credit card? Sounds kind of funny. You can't exactly swipe your credit card and buy a house, but there is a side way of learning how to buy a house with a credit card. Let's say that you don't have a down payment. Your first house that you buy, you need about 3.5% down payment. So on maybe 100,000, that's $3,500. So on 200,000, that's $7,000, and on 300,000, that's $10,500. If you have a credit card that has a limit of any one of those numbers, then you can slowly build up that credit card and then use the money that you saved as a down payment. So what happens is if you have some regular bills that, maybe they allow you to pay your electric bill on your credit card. I'm not telling you to run up a credit card because for clothes and for stupid things, but if you use cash for your groceries, or if you buy your groceries with your credit card and you pay your credit card off, let's say that you spend about $500 to $1,000 every single month. We'll say 500 on the lower end. You spend $500 on your credit card every single month and you pay it off diligently at the end of the month because you're very smart. You don't want to pay the interest on your credit card. That's a good thing. So now you're living check to check though, and you can't afford to not pay that because you'll just run up your credit card. But if you have groceries and regular bills that you need to pay anyways, and you have that $500, don't pay it off. Pay the very minimum. So you take 7 months to add $500 7 times, and you end up with $3,500 on your credit card. So if you didn't pay that bill, then you can put that $500 into your savings account instead. And what happens is you'll rack up your credit card to $3,500, you'll have $3,500 in your savings, and you'll be able to use that money to pay for a down payment on a $100,000 house. Now here's the thing. The only thing that credit card is going to affect when you're buying that house is the minimum monthly payment, which is going to be put into your debt to income ratio. Your gross income, take your gross income and multiply it times 0.4, because a bank or a lender will only allow you to use 40% of your gross income to buy a house. So once you have 40% of your gross yearly income, you divide it by 12 to get your monthly gross income. 40% of that number is going to be how much you can afford for all of your loans and monthly payments. So with that number, you're going to have to subtract your car payment and your student loan and the minimum payment on your credit card. So even though you saved up you racked up $3,500 in credit card debt, you actually only have a payment of about $35 per month, and that's going to get added into the number that you can no longer afford in the 40% of your debt to income ratio. So saving up that $3,500 is only a minor thing. You're going to be able to use that as a down payment. It only counts as $35 against your debt to income ratio. It doesn't count as $3,500 against your debt to income, only the payment that you have to continue making. So your car payment, your new mortgage payment, including interest and taxes, you don't have to minus off the taxes from your check. They already include that. You don't have to count all of your house bills like your electric bill and your heat bill. They include all of that by taking 60% off of your gross income and only allowing you to use 40% in the debt to income ratio. Hopefully you don't have a very big car payment. And even if you do, you can possibly even, sell your car for a temporary amount of time. If you can sell your car and just use a beater car for like 3 months and then get the car loan, it's much easier to just get a car loan when you already have a house than it is to get a house while you have a big car loan. It's just so much more difficult because the auto dealerships just don't look that much into your debt to income ratio, and they don't dig in and ask you for monthly statements of your credit cards and of your checking account and savings account. And the house, when you're buying a house, they dig into everything and they look at all of your monthly bills, and they do not care that you just racked up all of that credit card debt. I promise, I've done it. So when you buy your second house, you're not going to be able to buy it with 3.5% down. It's going to cost 25% or 20% sometimes, just to buy that house and rent it out as an investment. There are definitely ways, and there are plenty of lenders that allow you to buy your first house with 3.5% down. Once you live there for a year and a half or 2 years, then you can buy a new house with 5% down as long as you move into it and then rent out the old house. The problem is you're going to have to be able to afford both of the monthly payments. You're not going to be able to include potential rental income. You're going to have to have already had that rental income for a year or at least 6 months. It's going to have to be on your tax return. So you're going to have had that rental income for quite a while before they're going to allow it to count as income against your old mortgage and your new mortgage to buy a third property. But you can definitely buy your first house with a credit card if you rack it up, save that money, and then you only have a $35 to $50 monthly payment that's going to go against your debt to income ratio. And that is the trick to buying a house technically with a credit card. Good luck.